Hi everyone, Darren Kresovic, Mortgage Loan Officer. Today's topic of discussion is paying points. What are points? Who should pay points? And when should you pay points? Let's start off with what are points. Points are generally a cost that the borrower, would pay in addition to your normal and customary closing cost that would be used to achieve a lower interest rate. Now, there are some instances where points are paid for maybe it's a construction loan, or because it's a condominium, maybe because you have a low credit score. But today's topic is going to cover points solely used to buy down the interest rate to achieve a lower interest rate, if you will. So for example, 1 point will generally reduce your interest rate 0.25%, and 2 points 0.5%, 3 points 0.75%. Each point is 1% of your loan amount. So to keep the math simple, let's use a $100,000 loan as an example. So if you paid 1 point, that would be $1,000, and that would give you a payment that is 0.25% less in rate, and that would be $17 plus or minus lower in the monthly payment. So people say, well, does this make sense? Or how do I look at this? Well, the easiest way I explain it is you, the customer, pay an additional $1,000 to me, the lender, and in return, I'll give you a monthly payment that's $17 less per month. Now, there's some people that say, well, I'd rather have $1,000 in my bank account than my payment being $17 less per month. And it's going to vary from individual to individual. Most time when people are paying points, they consider paying 3 points, because that's going to get them down to 0.75%. So 3 points would be $3,000, and that's going to save you roughly $51 a month. So when would you pay points? Well, generally speaking, someone who views themselves as a house being a long-term purchase, meaning I'm going to be in this house forever. Well, maybe forever is plus 10 years. Then they could benefit from paying points. So by paying points, if you're going to save $51 a month, every month, it's going to take you 60 months to recover that initial $3,000 investment. So that 60 months is your break-even point. So every month thereafter is savings to you, the customer. So that's what people will analyze and use as a consideration when paying points. Now, in today's market, March of 2023, I would caution you. I think there's another factor that you should at least consider. You know, we're in this environment right now where the Fed is raising interest rates. I kind of feel like they've lost vision or sight of where they want to be. I know they're trying to fight inflation, but I don't think they know when they're going to stop cutting rates. Ultimately, you could see that this is going to generate a possible recession. And if it does generate a possible recession, that could create then a lower interest rate environment. So what is the probability or likelihood that in the next 5 years, if current rates are, let's say, high sixes, that we could see rates settle back because of a possible recession, maybe to the low fives or high fours? There's some experts out there that say that's highly likely and very probable. Now, granted, no one can predict the future. No one can predict interest rates, not even the Fed. So it's all speculation, but it's something to consider. And that point being is, should I really be paying or investing this $3,000 if my gut tells me that maybe I'll be able to refinance in the next 1, 2, 3, or 4 or 5 years? Something to think about. So hopefully this information is helpful and gives you a little bit more insight as to why paying points, who should pay points, and when you should pay points.